Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, February 4th, 2022. It is 11:58 Eastern Time as I'm starting the video, so we've got about 4 more hours to go in the trading day and in the trading week. What I'm going to do in this video is a relatively brief update on the equity markets, and then I want to go over the market-leading FAANG stocks. I want to talk about those, take a look at their technical posture, and just briefly go over what's happened recently and what to look for going forward, some key technical levels and or developments to watch for. I'll also do an update on Bitcoin. I might even get that out of the way first, either first or last, and then I just want to speak to one of the trades on the semiconductors that I posted recently. So let's start here. Let's just walk down the time frames on QQQ. This is a monthly chart, so this is as far back as we need to go. This goes back into the mid-90s right here, and you can see on this chart, you can see these yellow uptrend line or primary bull market uptrend lines. 1, 2, 3. So I'm still considering this whether or not we've had you want to consider that a bear market. We're in a bull market since the Nasdaq really bottomed in '08. Everything else in '09 right there. So this is the late 2008 primary bull market uptrend line. It is I believe, a magnet, a target. So at the very least, I think at some point this year, and most likely in the coming weeks to maybe coming months, we're going to check that trend line. When you get far enough away from primary trend line, especially when they're well defined like this one, you have a lot of reactions. You have the reactions there in the beginning. You've come and checked it along the way. That's what you do to key moving averages like this 20 period monthly moving average on a monthly chart. It defines bull markets during uptrends. And when you get too far away from it, you come and check it. You can see all these you checked it, checked it, and that's what happens. Checked. During the bull trend, check, check. Even then, so that tells you right there, that indicator, and that's why I'm looking at this. If you want to, again, it's semantics, whether you want to call a bear and a bull market or a bear market, a drop of 20% or more, a rise of 20% or more. Again, to me, that's old school definition, especially in this day and age of easy money in high beta, high growth stocks like the FANGs. So keep it simple. Again, whatever metric or whatever you want to call it, this is your trend right here. And it's, again, very well defined. And so look, at the least, I think we're going to visit that. And so off those highs from where we're at recently, that's going to be depending if and when we get there. I'm going to speak to that in a second here too on one of the on NVIDIA, that trade idea. But that'd be roughly, again, if it hits at this point, let's just say that is, when is that? That would be at the end of June right there where I'm holding. That would be a 32% drop from the highs. So what I put here is 18% in question marks because that's what the drop was so far. And what those drops, every one you see here, you see all these measured corrections and bear markets. I'm going to just read it off in case you can't see it in the video, and they're all associated with these. It's hard to see in the video, but there it is. There was a red bar on the PPO histogram. I talk about that as being a great trend indicator, and without exception, these are the drops. And again, I didn't miss any here. That every time you had the histogram make a bearish crossover, in other words, I'm sorry, the PPO line makes a bearish crossover. That's when the histogram goes red. These are the drops. So this one was associated with 19%, 20%, 29, 84. Yes, that's correct, 84%. Nasdaq got annihilated in that bear market because there was a bubble leading up to it. 18%, 55. That was the 2007 to '09 bear market. 16, 13, 26, 24, 31, and so far 18, and that's why I have a question mark. Why is it a question mark? Because I don't think it's over. It's certainly to the much closer to the low end of the range of just corrections along the way. And a lot of these corrections, you didn't have a fraction of the evidence to be short or that we were going much lower. In other words, this one, for example, came off the heels early on in the bull market. This time around, again, everything I've talked about, sentiment, divergences, valuations, a Fed beginning a new hiking cycle, everything else says that chances are that 18% drop off the high so far is not it and will continue down. And at bare minimum, even if you want to be, let's just say I was very long-term bullish right now, and I thought that the market had a lot more life left in it. That would be at least a correction target, and it's healthy correction. But again, and maybe that's where, and I'll tell you right now, I'll probably get a reaction, a tradable bounce off that trend line if and when we get there. And so that would be my most bullish scenario right now. is we pull back, and again, you have that drop of what 30 something percent off the highs, and then like it's done so many times before, you step in. However, you need to be prepared that just keep in mind, I always try to look ahead, and let's just assume I'm right for a minute, even if you're a bull. All right, let's just assume I'm right. If we get there, guess what? You're going to feel a lot different then than you do right now. The headlines are going to read a lot different. The news is going to be a lot more bearish. Earnings forecasts, economic growth forecasts, consumer sentiment, consumer spending, which is 2/3 of GDP, over 2/3, will have gone down. So at that point, it's going to increase the odds. Plus, nothing lasts forever. This bull market is getting, to say it's getting long in the tooth is it's a gross understatement. So take it for what it's worth. And again, that's it. Let's not beat a dead horse. Just wanted you to know that we had the confirming red histogram cross last month, the month of January. We're early on in February. Anything can and will happen, but look, we're pretty deep down there. I mean, that crossover is solid right now, and so it's really a matter of, is it going to be, something a lot longer? Is this the start of maybe the next bear market, or just another correction? So we'll let the charts dictate where we go, and if we even get down there to that level. By the way, look at that check of that beautiful 20-period exponential moving average on the monthly. I always talk about how well it defined bull markets. Even back then when COVID hit, it only took it out intra-month, and that's why I always preach, whatever time frame you're trading, the only thing that matters is how that candle closes. A 60-minute chart, it doesn't matter what happens in that 60-minute period. At the end of the hour when the candle's finalized, that's the important thing. So you can see that was a successful defense and test of the 20-month there and the following month, and then off to the races. And boom, we checked it again. So maybe that's it. Maybe not. We'll see. But if we take it out, that's last time we took it out was back when the last bear market happened right there. We took it, briefly popped it, tried to we popped it, tried to regain it, failed to, and then the rest of the 55% bear market resumed. We took it out there in 2000, and yep, sure enough, that defined a bear market, 84% drop, and ever since then we've been above it, and we've been in a bull market. So big level to watch, guys. A little bit comfortably above it right now, but just remember that if and when we do take another leg down, stocks tend to fall a lot faster than they rise, so we could be there in the blink of an eye. So anyway, that's that. Weekly chart, again, just an update for those just catching up or new to the site. We hit my first target a couple weeks ago, and as expected, had a reaction, a bounce there, and we need to take that out. Support is support until unless broken, so a break below the recent lows should open the door for a move down to my next target there around 299 on QQQ, and that's the weekly chart. And there's your longer term uptrend lines and additional downside potential targets there. Walk it down to the daily chart. All we see here, you can't see the lines I haven't turned down. This is basically a back test of the 200-day moving averages, which were broken, and now we're back below again after breaking them there, back testing and back down there. And again, on the daily chart, we hit the bottom of my first target swing zone as well, which was aligned with that weekly target. And then on the 60-minute chart, so far so good on that last objective shorting op there at the 370 price resistance plus 50% Fibonacci retracement level, perfect kiss and an impulsive rejection. You've got some support right here. You can see all these reactions right here when we had this. So I think if we can break that and get down in there, then we should run at the lows. And if we get anywhere near the lows, I suspect we'll take them out. There's a myriad of possibilities what can happen. I keep talking about the lows getting taken out and being bearish, and probably most likely will be. There's always a possibility we take them out. Maybe you have some divergence, and sometimes a correction ends with a second or third test of the lows. And again, there's a myriad of possibilities. If you're bullish, you can go long there, or I think the safer bet, if you break the lows, wait for a recovery back above and then go long with a stop below that recent low. But I don't think that's going to happen. Even if they pop back up, I think we're going to go lower. I think I've made very clear my thoughts, and if and when that changes, I'll let you know. And then, of course, there's, the NASDAQ 100 isn't everything. There's the SPY, S&P 500, And that made, as I mentioned the other day, at the same time the QQQ was back testing the 50% fib plus price resistance. SPY was also testing the 456-ish price resistance plus 61.8 fib, as I just circled there, and a rejection so far off that typical counter trend bounce retracement there. Okay, while I'm on SPY, you note down here I put the holdings of SPY, and what we're going to do is we're going to talk on these FAANG stocks. So I have these same FAANGs plus Tesla and NVIDIA. That's Apple, Microsoft, Amazon, Alphabet, Tesla, NVIDIA, and Facebook, now Meta. There's the previous all-time high right there in SPY, and we just recently back tested it and got rejected there. But this, I just wanted to say, I updated this last on December 8th. It hasn't changed much since then. I just updated on QQQ as well, or I did update it, I'm sorry, on QQQ through December 31st. That's what Invesco has, the website, the company that runs the QQQ ETF. I just wanted to say these numbers are going to be close, 27.5% weighting. The point is, and I always talk about, they're the same top weighted components in the S&P, but a much considerably lower rate weighting. It makes up only about a quarter of the S&P 500, this basket of 7 companies right there. However, and this is what we're going to do in this video, is take a look at QQQ. I had it from that last update back in early December through December 31st. This is the most recent data on the site through 12/31. These are the weightings. I'm going to read them out to you in case you can't see them. Apple 11.65%, Microsoft 10.09%, Amazon 6.76%. Both shares of Alphabet combined 7.16%. Facebook is next up. I just had to get leapfrogged. At that point, it was higher than Tesla, 4.76, Tesla 4.24, and NVIDIA at 4.14. From there, everything kind of drops off to much lower weightings. Collectively, again, these 7 companies make up 48.8%. That is half of the NASDAQ 100 is solely attributed to the performance of these 7 companies. So therefore, there's thousands of stocks in the stock market. 500 companies in the S&P 500, the Wilshire 5000, as the name implies, 5,000 companies all across all market caps. I don't need to know where all 5,000 companies are going. I only need to know where these 7 companies are going to know where the entire market is going, because they have such an impact. And obviously, QQQ and SPY are going to go together. So, so that's where I focus on these often. And I use it to supplement my analysis on the NASDAQ 100 and the market and S&P 500. So we're going to take a look at these today, and then I'll give you Bitcoin now, and then I'll roll into the analysis of the FAANGs if you're interested in that. Bitcoin, what I wanted to point out, let me find the futures first, then I'll go to GBTC for you guys and gals that don't trade futures. BRR are your Bitcoin futures, and there's also a micro or mini contract MBT you can trade as well. BRR recently highlighted to you guys this downtrend line right here. I mean, you can see a big divergent high back there and a nice cleanup trend line, rising wedge, and that was a catalyst for this correction. This is big support here, and we still may get there, and that's 30,361. But there's also pretty decent support there at 35,466, and there's a gap right there as well. And I mentioned this downtrend line the other day. I said, look, it'd be ideal if we get down there to go long, but I said we may break out of this trend line. We're close right now. I mean, right now we're starting to crack it. But there's big resistance ahead. So what I think is going to happen, I think we'll get another rejection. It'll prove to be a false breakout, but we're breaking out right now, just marginally above it. Again, I'm not. I'll tell you what I'm doing. It shouldn't matter. What I do should not matter what you do. Do trade as take the trades you like and pass on the ones that you don't. But again, that's resistance there. Now, if we break both levels, that's going to be pretty bullish. But again, an optimal or ideal scenario that I'd like to see would be a push down here to that 3361-ish level there, whether we have a false breakout or not, and then to have positive divergence. And if it happened anytime soon, we'd have bullish divergence, and that'd give us a little wedge type pattern, and then take a position there and or add as you take out the resistance levels above. Again, 35,466 is support. Here, I'll zoom in tighter so you can see it up close. This is, of course, a daily chart. See, that's support. There's the candle popping, trying to pop, well, right now, intraday at least, popping the trend line. There's resistance just above. And then I'd have next resistance probably about right there, 43,655, but then even bigger resistance there, about 45,878. So if you take Bitcoin or you're long now, that would be a logical target. Then up there about 51,684. And there's the again, we have a little bit. No, we don't have divergence, not yet. So I just want to update that. Let me give you GBTC if you like that. And here's the thing: GBTC is at support. Way back here, I had I gave you a sell signal. We shorted Bitcoin. Actually, we shorted it right there, day after the high, and that was a long-term short. I gave you 1, 2, 3 targets. We hit my third and final target, at which point I posted as a long to reverse, and I mentioned again there when we had a second test of that level. I gave you long targets, and we shorted it here. And mentioned it at resistance and a short up here. But that is where I'm going with that, is not just trying to tout on those previous trades. There's a major reaction high there, 2 major reaction lows that marked a significant bottom that sent us back to the all-time highs, and that's what we just hit recently. And we even had a little intraday whipsaw candle, but we closed back above there, right there. So here, zoom in tight. And we took out today. We took out this minor downtrend line. Then you have this longer term trend line in play, but you also have resistance just overhead. That's probably where we're going to get checked. So I think, again, I'm just giving you my hunch, probably be a false breakout, but you can take it and let it run with stops in place. I can tell you this, you're a little, if you can do it, I'm not trying to convince anyone to do anything they're not comfortable with, or if you don't have the experience level, but the thing I like about futures is you can have those round the clock stops. GBTC tracks the futures. I believe it tracks Bitcoin. I don't know what they hold, whether it's the futures or the actual Bitcoin. You can look it up. But it's prone to gaps because of that. Bitcoin can make some big moves overnight. And, let's say you were long GBTC this day, it closed here. Well, the next day it opened up around 12% lower on a gap down. So that's the nature of that beast, because you can only trade this one, and it doesn't even trade in pre or post market. I believe it only trades regular sessions during the regular session. Okay, and back to the FAAMGs. Before I get into the FAAMGs, I wanted to comment on NVIDIA. Some good comments, and I appreciate these, by Becky and member Yahoo down here, thinking the same thing, end of world scenario, saying, holy cow, 15 price target for NVIDIA. And so my answer to that was, look, no, not really. And I went on to explain here. I'll show you the chart. Or you can read it, go to that comment section. So what I did in that first one, and what I referenced is I gave you 3 semiconductor trade ideas based on long-term charts. If you want to, swing for the fences here and make a big trade, assuming I'm right on those. Some of those are actionable now, some are setups and needing to trigger an objective short entry. But the point is, and what I went on to say in that in the reply to Becky is, no, when I give you levels and I show these little arrows, sometimes I'll just do the arrow breaks. I don't show the counter trend runs, any arrow break. Price levels are price levels. That's 129, that's 74, roughly, that's about 47 and 32. This is the chart I updated here. Let me get to the live chart in NVIDIA and I'll show you. This is the one in that post. But so NVIDIA, yes, in the post that I put yesterday, I had the arrows drawn coming down, taken all the way down to about 15. But that was just as I said in one of the other semi setups. I forget which one it is. I said the price levels are the price levels where I think we're going, and we'll get reactions. But trend lines are not those arrows. In other words, I don't draw to time. Because I don't have enough room here, and that's also, it's one thing, and I say this often, this is why I'm not a big options trader. Believe me, I've plenty of experience trading them, but it's one thing, it's hard enough to get the call right on where a stock is going, and unlike analysts on Wall Street, I'm pretty precise. My targets are within a percent or so of where I think the stock's going, and game the bounces along the way. So it's one thing to get that call right, where a stock is going to go from where it is today. And I'm talking, significant moves. it is a whole nother degree of difficulty to predict when the stock is going to get there. Because if that was easy to do, just leverage up. I would be trading options using that 100-to-1 leverage factor. Options contract typically represents 100 shares. Load up on options, and but the thing with options is you not only have to get the price move correct, you've got to get the timing correct because you have expiration dates. Futures, you can keep rolling. Stocks, if you're short, you can hold on and wait, and sometimes you get those targets hit pretty quick. Sometimes it takes longer. Now, a lot of times I'll give you an estimate. A lot of times I have an idea of when things are going to get there. But where I'm going with this and what I said in that comment section, this is the bull market. This is it. This is NVIDIA. The stock came public back here in around beginning of 1999, just in time for the big dot-com bubble. And this is just to me, a beautiful uptrend line. Why is it beautiful? Because it's super well defined. There's a lot of reactions going back decades, clean, distinct reactions. And what I say is that these uptrend lines, when they're that well defined, that's your secular bull market uptrend line. There's secular, which are the bigger picture bull and bear markets, and then there's cyclical. This is a cyclical bull market in NVIDIA, a cyclical bear. Cyclical bull, cyclical bear. And they're not just random. They can be predicted with a fair degree of accuracy. You look at the uptrend lines, that's a bearish rising wedge, negative divergence, just like I would trade on a 60-minute chart or a daily chart. This is a monthly chart. So again, the takeaway is when I'm analyzing off the monthly time frame, if I see a big bearish rising wedge pattern that's taken years to form, I'm not looking for a 10% correction. I'm looking for, and that's what I followed up to that first reply I made to Becky. Guess what? This was the first time we had a correction back to that trend line right here. And you can see my pop-up box left. That was a 90, before I measured it was 91% drop. Call it 90. This one was an 85% drop. That was the bull market run up to the 2007 highs, down to the '08 lows in the video right there. Another check of the trend line. So what I had said here is what I had to do. If you want to try to get an idea, I don't think NVIDIA is going to 15. That was the point. If you look at it here, if we drop straight down, but look, guys, you got to go. You'd have to hit that. I'll tell you when you'd have to hit it to have it come in around the $15 level. We'd have to hit it in 3 months. We're not going to drop. NVIDIA is not going to drop 90% from the highs in 3 months, 3 or 4 months. So what I did and what I was trying to explain there is trend lines are dynamic, meaning they come in. If it's an uptrend line, it comes in every single day as time goes on at higher and higher price levels. So in the example I did there, I had to drag this out, and my guesstimate, if I'm going to be correct, and we're going to go on a visit, it's going to play out something along these lines. That's a big arrow, but hit that level, the uptrend line. This is the uptrend line off the 20. What is that? About 15 lows. Come down there, hit that trend line, bounce, ultimately going to take that out, that 129 support plus the trend line, hit this 74 level, bounce, come down here at about $46, $47. Somewhere along the line might have a year long or so consolidation, and ultimately work our way down here and probably hit that, come in and check that bull market uptrend line. And guys, this is it's still a longer term bullish outlook. But obviously, it's aggressive. I'm calling for a 90% drop. If that's what it hit. I just want to clarify, not 15. I think that line would come in probably closer to this level right here. And that would, I think, be the maximum downside in NVIDIA. And somebody said like doomsday call. No, again, it's very clear that is the norm when you have, and these also coincided with the only two cyclical bear markets that we've had in decades. Again, if that's not counting what happened when COVID hit, but there was that fourth quarter drop in 2018, and that was, that alone took the stock from about 74 down to 32, and that was about a 60% drop right there. That's just that was just a correction within an ongoing bull market. So I'll leave it at this. You need to understand the nature of what you trade. And for me to call a 90%, potentially a 90% drop, I doubt very few here, including myself, are going to probably be shorting a video that whole way down. I may put on a short, but if I did, I can tell you, I will be gaming. I can guarantee I'll be reversing at some points along the way. in gaming counter trend rallies, because the counter trend rallies are going to be powerful as well. Um, so that's that. Oh, the other thing, what I was trying to say is know your security. I always say that. Semiconductors, it is a boom or bust business. And what's going to happen at some point, and it always has, and that's why these semis correct this much. This is not specific to NVIDIA, not 85, 90% drops. It's the nature of this industry. When everything's booming as it has been, they're ramping up production to full capacity, and at some point there's going to be the ship is going to turn, the economy is going to turn. It's just inevitable. I don't wish for recessions, but they are a absolute necessity and a certainty in the economic cycle. You have booms and busts, and when that happens, consumer demand slows, less cars are made, airplanes, everything, TVs, and then all of a sudden there's a glut of chips on the market and prices crash. And so therefore the stocks, are priced in, assuming that the current growth rate is going to continue forever, all of a sudden that changes. And again, that's where you have that. So all right, let's not talk much more on that. I just wanted to say, and the fact, by the way, that these corrections happened back then. This one we have big negative divergence. So I also want to say that I've heard some smart folks out there that've been doing this a long time liken current economic conditions to the Roaring Twenties. I think 1929 crash the markets in the Great Recession. Now look, I know it's not there are of course a lot of differences between now and then, but I would have to say that I can see that. So we could be looking in the coming years at a doozy of a bear market that could last a lot longer than these, which were relatively quick. These were about a year and a half long, if that, the last two bears. So anyway, that's it. Trade it as you want. I just think that's a possibility. And now let's look at the big fangs. Okay, so I gave you the weightings. So we'll start out with the 800-pound gorilla, largest publicly traded company in the world. Apple, it was recently a $3 trillion company, a little bit below that now. So here's what I'm watching. Apple, the strongest of the lot. I mean, just obviously one of the most profitable, well, yes, the most profitable and biggest company in history, earnings juggernaut, but everything has its run, and then you have corrections. I don't know where these lines are all distorted, but you have big divergence building. This is a weekly chart on Apple. Let me just show you what to look for here on the daily charts. So Apple, as they always do, blew the cover off the ball, record earnings, just check marks along just about all product lines. I think the only thing where they missed was iPad sales, our expectations. Everything else was just stellar. And, the market rallied. But number one, the stock is still well below the previous high. The technicals say it's going a lot lower. And so what I'm watching for, and on all these, is here's the post-earnings pop. I have a line right here. You probably can't see it in the video. That's when they reported. And they report after the bell like most big techs do. So that was where they closed, and the next day they pop. They bought it. They're starting to fade that rally, but they've got work to do. But I think it's safe to say if and when, as I expect it'll be, the entire post-earnings pop is faded, that's where you're going to have just a lot of stops hit. Fund managers that bought just thinking, how can you not want to own this stock with that kind of earnings? Because again, stock market looks ahead. And if this happens, it's all intertwined. Like I said, it's just all part of one big living, breathing organism, if you will. And if technicals play out, that could be the fundamental catalyst for a bear market or more downside in the market. Well, how does that work, Randy? Well, remember, consumer confidence and consumer spending and confidence. Consumer spending is over 2/3 of GDP. And so if the charts play out as they look to be, and we start going down with Apple and the rest of the stocks in the stock market, your 401k goes down. If we have a 30% correction or more in the stock market, that's going to definitely change people's mindset, their confidence, and their spending habits. Likewise, the housing market and the stock market tend to ebb and flow together as well. So those two components make up the majority of people's wealth: the value in their home and the stock market value of their investments. And we all know we're looking at a rising rate environment that's already putting the brakes on the home builders and all that. and will probably continue to do so. So that's it. Anyways, it hasn't happened yet. Apple took out that near-term downtrend line, ran into, at this point I'm going to move this resistance line to right here because we had a couple reaction highs and then some reactions there. So bulls want to see that level get taken out about 176, maybe a little bull flagging action, and then we could maybe even see new highs in Apple. Bears want to see this post earnings rally faded and especially see this level. That's still a big level to me. I'm going to color up that yellow 157, we'll call it, the recent lows roughly, and then these reactions in that previous all-time high right there. So bears, check mark if that's taken out. First check mark would be if the post earnings rally is faded out. That's where the bears get their check marks, and the bulls get check marks. You know, they can take out 176 and the old highs, but if they do, I can tell you it's not, I don't think it's off to the races for Apple because we're just going to simply extend that negative divergence. So to me, as of now, nothing on my longer term outlook would change if we made a marginal new high in Apple and the market. But if we go up much more than that, yeah, it will, and that's where start stopping out of swing positions. All right, next up, Microsoft, second largest holding. Here's our earnings right here. I have a line on January 25th. That's this candle right here. Microsoft beat, market liked what it heard, and it took, just like Apple, had a near-term downtrend line. Just like Apple and everything else, we hit my target, so the bounce was to be expected. This is all the initial reaction off my first target on QQQ. They all bounce, they're all running in, doing, as of now, just typical counter trend rallies. Microsoft is still well off its all-time highs, and again, the technicals were overwhelmingly bearish. Big divergences all the way on the daily, weekly, and even monthly charts on a lot of these stocks. And so, what you want to see on Microsoft, obviously the bulls want to see this level. I have important levels in yellow, 317. That was this trading range right here, right? Bulls want to see that recovered. And there's also a long-term trend line that comes into play right here. We're well below that. So, this would be like a near-term bullish but longer-term bearish scenario to come up and test that. Whereas if we can just fade this rally, we tested the 200 days. They're right here recently. So if we can move back down right about below 295, yep, right there. You might not be able to make them out in the video, but I have pinching together right now. The 200 simple and exponential moving averages are right around 295, as is the post earnings rally. Remember, that was our closing candle. They reported that night. So this is it, magic number where you get a check mark for the bears, and then even bigger if we can take out 283 on a closing basis. We only popped it intraday. That was when you should have been covering shorts and or buying if you're an active trader, because we hit my first targets on QQQ, and that was also the bounce for Microsoft was from that low. You covered, if you were short Microsoft and you reversed to a long, you'd be up 14% on the counter trend bounce. That's active trading, and then you can short right here at the 317 resistance, or could have, and for the next leg down. Or if you're a bull, and you bought it there at this point in time, the takeaway is I give you my analysis, I tell you where I think things are going, but I point out the important levels. So if I was bullish and thought Microsoft was going up, at least maybe for that trend line or to new highs and beyond, I'd have a stop a little bit below that 295 level. It should quote unquote successfully hold a back test of the 200s if it checks them now or several times, and that level I showed you there. Worst case, stop below the recent lows would be the widest stop. All right, that's Microsoft and what to look for there. Alphabet. This is the A shares, GOGL. We can also look at these. Let me see which chart's a little more clean. This one's clean. All right, so what's the other share class? First of all, so there's where we closed the night before earnings or the day of, and then popped up on earnings. And what I wanted to show you is they're fading this one hard. Alphabet had a very strong reaction, big pop after earnings, even higher in the after session, but even the regular session about a 10% rally. Look where it got checked right at the previous all-time high, which is obviously resistance, about 30.30 in price. So far they faded. I could put up fibs, but it doesn't matter. I can eyeball it. That's about a 61.8% fade. About 2/3, a good 2/3 of the from here, that's where we closed, popped up there, and look where we're already back down to. It's also support right there. So what I'm watching for And what I'd like to see is a position short is a complete fade of that rally, because that's that rut row moment for fund managers and individual investors that bought Alphabet on those blowout earnings. It shows you a change of characters. If a stock can't rally and build on those gains, then that just shows you it's simple, that the supply demand dynamics have shifted. There's more sellers in the market than there are buyers. There's also an uptrend line off the lows. So, and that's going to come in right around a failure of that post earnings breakout. And then, this was a level. It's been traded through now. So really, again, it's about the lows. If we take that out, check mark. If we take out the lows, another check mark. PPO is still in bearish territory, and that's why I think that's the most likely scenario. That and everything else, this big divergent high and everything, these corrections just haven't been in line with what the technicals are indicating so far. Again, appears like the initial leg down with a counter trend bounce. And what do we have next? Covered Microsoft, Amazon. Amazon's interesting. Okay, so we had, you don't see it here. I had to turn on, and I did for you. I gave you this has it turned on. Here's that weekly chart. I gave you two scenarios yesterday for the close. One was if Amazon crapped out after earnings, that was it, because we were back testing the bottom of the range. And I gave you an alternative scenario, which was they're both the same, longer term bearish. There's no waffling there. It's just a matter of a near term bullish post earnings, ready for a post earnings pop. And that was it. It was a near perfect back test. That's exactly where I had that arrow going, to back test this trend line and then a reversal. So far, so good. The stock's still up 13% today, so you can't knock it. But what I see, and that's what bulls see, I see a perfect back test and a rejection. Again, that back test happened in the after hour session, which is just as important. Those trades were real, they took place, and it would be great if there was round the clock trading. I think some brokers have that now, but the regular pre and post market sessions, that's what will show on this charting program, and that's when most of the volume goes. 3 in the morning, I don't know who's trading Amazon, but maybe somebody. Anyway, that's that. Now, but of course, look, am I right? Not so far on that alternative scenario, so far, but I had that rejection, and then us coming down to that longer term trend line, and probably get a reaction there, and then more downside. So really a check mark so far, because there was a pretty impulsive rejection, but work to be done. I mean, we're up 15%, we're well off the lows. We need to now take out those recent lows. Okay, so that's the level I'm watching. And then where do we start getting X marks for the bearish case? And again, this is only one company, so you can't put too much into it. Well, there's a downtrend line here. Let me turn off the after hour session trades. Okay, that's where we're at today, and I just showed you there's a downtrend line right there, and that's what we're testing. So it would be ideal to see a rejection here on that downtrend line, and even better. So check. So far, a reversal there was the check. Check if we break that level. Check if we get a rejection off this trend line. And the bulls get a check, and the bears get a little X mark. If Amazon can take that out, and at that point, then they have these previous highs. And again, that would be a near-term bullish but longer-term bearish scenario for me. I don't think it's going to happen, but if it does, we'll adjust to it at the time. And then finally, Meta, Facebook. We all know what happened to Facebook. They got clocked. They had a nice potential, setup here, positive divergence on the daily time frame, a wedge, even the breakout of the trend line. But I warned you, this is why I don't take breakouts, whether they're bullish or bearish, right in front of earnings. It's a gamble. It's a crapshoot. There's a much higher risk of failure. And so all those that took that breakout got smoked on that gap down. I already talked about that, how stops do you no good. If you had a stop loss order here, whether it was stop limit or stop loss, did nothing for you. Got bypassed at the open. So that's Facebook. And now bigger picture, see this yellow line? That was, remember I had this way back here. I said that's bearish. That's the level I wanted to see get taken out. So this is another for me, big check mark for the bearish case. This was a big support level right there. It was all-time highs here. Stock was consolidating, then had a breakout, big green candle. See that? Impulsive, ran up, put in a divergent high, which caused a correction, but back tested, back tested, back tested, and now we've taken out that level, and we took it out via a gap. That's pretty darn bearish too, because what that does, it traps people in that might have when looking to were long, and now they're below that level, and so there it is on the weekly chart. You can see that. So here it is, man. Any kickback to that level, great, but we already broke it. So it's possible. Now, bulls want to see it recovered. And if they do, they've got a mega gap to backfill overhead. So, that's a possibility. There's always possibilities, but right now we're below resistance, and as I like to say, resistance is resistance until and unless taken out. So that is a level I'm watching for one of the market leading stocks. And if not, should, I'd put this more, I don't know, if you're interested in shorting. It's easy to just short the Qs, or take NQ because it's leveraged, because these ones I'm going over are the performance. They're 50% of the weighting of NQ. So why not, short the basket? And then you don't have the risk of gaps like this. Yeah, earnings is out of the way now. That's usually where you're going to get the biggest gaps, but there's always some news that can come out overnight in any one stock. So, you can trade these individual, or you just trade the Qs or NQ. All right, enough on Facebook. I told you two more. We'll cover Tesla, and it's a big component. So on the daily chart, we broke the yellow uptrend line recently. Back tested it, impulsive rejection. We're still below it, flirting around with this 900-ish level right there, 905. You can also draw a trend line off the highs, which you should, because that's what Apple and Alphabet took out. So ideally, you want to see a rejection there to move back down. If they pop it, there's still major trend line that you just get another back test of the trend line. That would be your next resistance level and objective short entry. Check mark to the bulls if they can recover the trend line with conviction. Check marks to the bears if we get back test with an impulsive rejection, and then even a better check mark if we don't even take out this trend line and just turn down. Today's Friday, so barring any big moves into the close, they're probably going to keep us guessing until next week. So let's see. Yeah, and then there's NVIDIA, which I just covered, started the video with earlier. Showed you on the long-term time frame, but there's on the shorter term, here's that trend line on the daily chart. Check, 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 and a breakdown and a back test. And so again, you need to see NVIDIA take out the recent lows, and one fundamental potential headwind. Let's just say that the Bitcoin bubble, crypto bubble, has finally burst. Let's just go with that. I mean, NVIDIA, a big part of their sales in recent years is that Bitcoin has been a huge boom, because that's the crypto mining. I think they lead with video cards and graphics cards that are with the powerful processing computing power. I know that. I have a teenage son who's wanted to mine crypto. He wanted to turn one of our spare rooms into a crypto mining facility, which of course my wife and I said no to. But and so yeah, he's told me for years about these cards. Anyway, so that's just one thing there. And again, doesn't matter. It's who knows? Maybe Bitcoin goes in the moon, and I think the charts will still tell me that NVIDIA in the coming months to even years is most likely headed lower. But again, trade off the shorter term charts to try to game the near term bounces, and look to where you want to objectively add short exposure, or get out, add to or subtract. There's a downtrend line, and that price resistance has been traded through a few times, so I'm not putting a big weighting in there. And the downtrend line's not super well defined, but again, I think this is the most likely path for NVIDIA, and a lot more. That one, again, I gave you the trade setup. I gave it to you on the weekly chart here. So, near term, if you're targeting, just say that 73 level right there, that's, from where we're at now, that'd be a drop of 70%. I mean, you can give yourself a 20% stop loss, and you still have an excellent risk-reward ratio, and a 20% stop loss would be right about here. So that would allow you up to about 300, 304. It would allow for to continue to backtest this trend line for a while, and still, keep you in the trade. And again, if you're going to try to swing down to these targets and you're not an active trader, you need to allow wide stops, because a counter trend rallies in a stock like NVIDIA, so far off the recent lows, it's rallied 26%. However, off the recent highs, it's fallen 40%, 41%. So again, I call it the know your security rule. You need to know the nature of whatever you're trading. And if you're trading Bitcoin or semiconductor stocks and you're running a 2-3% stop loss, just don't even bother. Don't waste your time. You're going to get stopped out in the daily back and forth of that. You need to take your position size down smaller, give yourself a wider stop and larger price targets, and then just trust the charts. I like to set those OCO orders. One cancels another. You got a stop loss above and a sell cover, buy to cover limit order down below, and one of the two is going to get hit, and then it'll cancel out the other order for you. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.